Hello and welcome to the Owner Finance Academy, where we help Canadians build wealth by buying U.S. real estate and selling with owner financing. Before we begin, a quick reminder that everything on this channel is for educational purposes only. Every situation is different, so please do consult your own qualified legal, tax, accounting, and financial professional before making your own investment decisions. In this video, we'll compare the lifetime cash flow of an owner finance real estate deal to the lifetime cash flow of the same amount of money invested in the stock market. So let's first look at the lifetime cash flow of the owner financing deal. In this scenario, we will go through the typical steps, starting with finding our financing, then moving on to the purchase. So in order to do this analysis, we'll have some inputs. First input will be the loan amount. So we are going to borrow from a Canadian source the equivalent of $46,000. And we will set the interest rate here to be, say, 8%, and our loan term to be, say, 5 years. So now that we have our own funds, we're ready to proceed with the acquisition. You'll note here that our monthly obligation is $933, thereabouts. So we know for sure that we need to be buying a property in a market where the rent is exceeding $933, so that when we charge whatever amount we charge, we're covering our own costs. So let's proceed with the acquisition. We'll set the purchase price for this property at $40,000 and closing costs at about $3,000. And if you are a Canadian watching this and wondering where are there properties for $40,000, I encourage you to look up Zillow or Realtor.com and check out a few states, including Michigan and Illinois, and the list goes on. All right, so now we have this in place. We know how much we have to buy the property. We also know the closing cost. You'll notice there's a $3,000 surplus there, which we're going to use as our buffer in case there are defaults during the tenure of our tenant buyer. Then we'll be able to cover those periods of time. So the next stage, we want to determine how much we're selling this thing for. So we purchased it for $40,000. We're going to sell it for a price that reflects the value that we're providing to the buyer. And remember that a lot of the value we're providing to the buyer is actually in the financing. We're providing them a service and access to a home and using a financing option that isn't available to them otherwise. This is the value that we're providing them with the owner financing. So that price is going to reflect all of that value and the fact that we took on risk by choosing to invest this way. So $86,000 will be the selling price. We're going to require a $3,000 down payment from our buyer. The interest rate is going to follow the usury laws in that state. So if we are buying in a state where the maximum is, say, 11%, then we will charge something like 10%. And the contract term is the amortization for the loan. So we are selling on a 30-year amortization, which matches what they would get if they were getting a mortgage from a bank. All right, so now we know that it's going to take them 30 years at around $730 a month in order to cover that obligation. But of course, that's not what we're going to be charging them. We need to charge enough to cover our own cost and also cover property taxes and insurance, which we'll cover in the next stage. So we would normally find the property in a market, do rental comps, find out what the going rent is for that property type, say 3 bedrooms, 1 bathroom in a similar neighborhood, a house in a similar living condition. And so let's pretend we've done that work here and we figured out that we can charge $1,150. We have a delta of around $220 that's left over, and we're going to use that $220 not to put in our pockets, but to pay property taxes. And we'll set this to say 120, and then we'll set insurance to 80. All right, so now we have a picture of our cash flow situation for the first 5 years while we are repaying back our loan. And as you can see, there's really nothing to speak of. And this is a known feature of the slow flip owner financing strategy. For the first 5 years, we're not making any money. Our aim is simply to pay back our original loan and set ourselves up so that years 6 to 30 are the years where we're receiving our real cash flow. So let's extrapolate now and look at a full table showing the cash flow for both periods. Let's have a look at the cash flow for the first 5 years and the ensuing 25 years. So you'll notice, as we've mentioned, the first 5 years, there is nothing to speak of. And really, the bulk of the cash flow kicks in years 6 onwards. And you'll notice here that we still have our property taxes and our insurance. So this is a yearly amount, but the net cash flow is essentially the amount that used to go towards payment for the loan that we no longer have to pay, and that stays with us. And we could say here, show this monthly, so that you can get a sense of what your monthly cash flow will be. So again, for years 1 to 5, we've got nothing to speak of, but for years 6 to 30, we were looking at around $950 of cash flow per month. So this is a typical slow flip. And to answer the question that we asked at the beginning, what is the total lifetime cash flow of this deal? $285,000 net. So this is after property taxes, after insurance, and after having paid for our own loan. Now, a few things are interesting here and worth noting. Of course, this is an ideal situation, a situation in which our buyer is faithful for the entire 30 years. There's never a default. They never turn over. Now, all these things are ideal. They may or may not happen. So if they didn't happen and our buyer actually left, well, there would be periods of time here during which we wouldn't be receiving payment. And of course, our cash flow would be diminished. But this is in the world of speculation, where all things are possible. For the purpose of modeling a what-if scenario, we keep this simple and look at the best case scenario, and this is what it would look like. All right, so we always want to compare this strategy to something else, because you could definitely be putting your money somewhere else, such as the stock market, and doing something much more passive and seeing what the results would be of that approach. So I love to do this comparison. Let us compare this same investment to the stock market. All right. So now we're going to determine what the annual return is. So the experts tell us that the annual return on average is about 8%. So 8% invested for 30 years using the same loan and at the same interest. All right. So we are essentially taking the same money we could have spent on the slow flip real estate deal and putting that money instead in the stock market. And here's how that plays out. I take the 46K. I have to pay back my loan for the first 5 years, but starting from year 6 onwards, that money stays in the portfolio and continues to grow. And therefore, by the end of the 30-year period, I end up with 406K. And I'm going to do this here, show cash flow for first 5 years and remaining 25, so that we can do a comparison to the other situation. So you'll notice here, this is where things get interesting. For the first 5 years in this model, we are having to pay our loan payments out of our own pocket, because if the money is tied up in a portfolio in the stock market, then it's not generating cash that we can withdraw. So this money then comes out of our own pocket for the first 5 years. And then for the remaining 25 years, there is no cash flow in the stock market scenario. And that's the big difference between the stock market and the slow flip and the real estate investment. It's that at the end of the stock market journey, the 30 years, you definitely end up with more money. As you can see in this scenario, we ended up with 406,000 versus in the slow flip scenario, we will have withdrawn 285. So if your goal is to set it and forget it for 30 years, and at the end of the 30 years, wake up and go to your account and see which yielded the most money, then the best approach is to put your money in the stock market. Put that money in there, wait 30 years, and then you will see more money by doing the stock market route. But if you were trying to, say, withdraw money from the stock market at the same rate as you would have been receiving in the slow flip strategy, so if we go back up here and we see how much we were expected to withdraw per year, this is when the analysis gets really interesting. So I would say here, assume I want to withdraw the same cash flow from the stock market starting in year 6 and onward. Show the analysis. And this is where the slow flip strategy has some merit. So we'll look at this here. So you'll see what this is showing us is that, as we know, for the first 5 years, there's no money coming out. But then starting in year 6, let's say we were doing the same kind of withdrawal, a monthly withdrawal of $950 per month, which is what the slow flip cash flow strategy is producing for us. This is telling us that we would actually no longer be able to withdraw after year 13. So whereas in the slow flip strategy, we are able to withdraw $950 per month every month right up until the 30 years, because that's what we're receiving from our buyer. If you do this in the stock market, you can only withdraw right up until year 13. So after this, you are no longer able to withdraw. And we could say, show the withdrawal in a table per year to make it even more clear to us. And what you see is that year 6, you're okay. Year 7, you're okay. Year 8, you're okay. But now what you're looking at on this side is the depletion of your stock market portfolio. And then when you get to year 14, bang, you're out of money. And now we could say compare to the slow flip, and you will see in the side by side that you've got one in which the money stops and the other in which it continues. So here we've got it at year 14, thereabouts. There's no more money in the stock market, but in the slow flip, you can keep going right up until year 30 because you're continuing to receive your payments. So this analysis, I think, shows a few things quite clearly. If your goal is to do one thing at the beginning of 30 years and do nothing else for 30 years and one day look up at your account and find money, then the stock market will win based on these assumptions. If your goal, however, is during the 30-year time to be able to withdraw money and have cash flow to live on and enjoy and do things, then it seems that based on the same parameters, the slow flip real estate owner financing strategy would win out, because with the stock market, you would run out of money at year 14 versus a slow flip, which could continue to produce funds for you right up until you're 30. Now, if you really wanted to combine these, this is what you could do. You could say, what would happen if I took the withdrawals from the slow flip and invested them in the stock market? Now, that is a really, really interesting scenario because you're combining the best of both worlds. So it's a mix of active and passive. So first 5 years, you are doing nothing interesting in terms of cash flow, as we talked about, not much going on. But then in years 6 to 30, you essentially take that money, that $11,400 that the house is producing, and rather than spending it on your own thing, you take that money and you put it right into the stock market. And what you'll find is at the end of the 30-year, you'll end up with $840,000 instead of $406 if you had done nothing but just take the initial money and put it in the stock market. Now you're combining the strength of both strategies. You do the slow flip, generate cash flow, use that cash flow, put it in the stock market, wait 30 years, and voila. And this is a pretty powerful tool considering you borrowed the funds to begin with. So you're really only managing effort, energy, and time, and risking some borrowed funds. Well, we hope this was interesting analysis for you. Key messages are slow flip are great if you're looking for ongoing cash flow. Stock market is great if you're looking to set and forget, and both are wonderful if you've got the discipline and you're looking to maximize your profits. See you in the next one.